Today I wanted to talk about tail risk. It's something I think everybody in this room is quite familiar with. Unfortunately, in the last decade, we've had two, as I'll show you a little bit later, two substantial drawdowns in the market, which are quite uncommon if you look at theory, and if we look at the academic books, it would tell you that you should not expect those type of tail events that close to each other and not that often and not that extreme. So I want to talk a little bit about tail risk. We've been talking about this with our clients for the last couple of years, for sure, and we've seen a lot of traction with our clients in terms of starting to execute and start to invest in strategies that we think can help mitigate some of that tail risk. I'd like to spend about 5 minutes just talking about a survey that we did recently. We commissioned the Economist intelligence unit to help us with to complement a paper that we were writing on tail risk, on managing in volatile and certainly uncertain times. And in that paper, we did a survey. We had the Economist do a survey for us. They surveyed about 310 institutional investors across, and that was evenly split between the U.S. and Europe. Quite a good contingent of institutional investors that were part of this survey. So we think it gives a quite good affirmation of what certainly we've been seeing in our individual meetings with you and other clients. And I'll go through just a couple of slides to show you some of the highlights from that. And of course, you can see on here, there is, if you go to SSgA's website, you'll be able to download that report, which is, I can tell you, has probably been one of the most downloaded reports in the history of our online web service. So it's been quite well received by the investors. So if we talk about, we gave the question, you know, what do you feel, what do investors feel would be the most likely? This was, and I will caveat this was back in June. And I think when you see some of the items up on the slide, I'll reference those, and I think you'll understand why I wanted to make sure that you knew this was done in June. But we asked the question, what do you think would be the most likely cause of a tail event? And there's a lot of things up here, a lot of issues that we're dealing with today. But you know, if you look at the Eurozone breakup, 33% and the Greek exit, 29%. So that was a pretty good number, but this was back in June. This was before we had a very successful move by the central bank, the ECB, to take what I believe took systemic risk off the table for the Eurozone. And I suspect if you did this survey today, I'm pretty confident those would fall down much lower. Contrast that, if you look down, I know I saw it on here, U.S. politicians, my home country remained deadlocked, 17%. I think in June, you know, the election was still coming up. December was a long way away. Today, if you did this survey, I'm pretty confident that the risk of a fiscal cliff, which we estimate is around 5% of GDP if it doesn't get resolved, would be certainly at the top of this list. So this list is interesting. It's interesting to lay out what people were thinking at the time, institutional investors. But I think what I'd like everybody here to understand, and my observation of this, is there's always going to be things that we're worried about in the market. Unfortunately, if anybody had the perfect forecast to know which of these things was actually going to happen, I would bet that you still would not be successful in trying to anticipate how the market reacts to it. And that's an important aspect and an important observation for how we look at tail risk management, in that you can't protect for any one individual risk and you can't time any individual risk. A couple more slides on the survey, and then I'll get into a couple of strategies we'd like you to think about in terms of managing tail risk. This question was basically asking, at the time, what strategies did you look at as an institutional investor before the crisis, and what do you look at now in terms of managing, in your belief, tail risk? And these, when you look at them, step back a bit, they all look quite close to each other, but there are some interesting variances for the individuals that answered the question at the same time. Diversification across traditional asset classes, which has pretty much been the mainstay means of lowering your risk, is through diversification of traditional asset classes. That's come down, and I suspect if we did that today, it would come down even further. At least in our conversations with clients, there's less and less focus on diversifying across asset classes, and more on some of the other things on this slide. I thought interesting was hedge fund allocations were in this survey came down pretty materially in the minds of investors in terms of where they thought they would be investing going forward to manage tail risk. There's two things on here that I wanted to draw out today in the limited time. There's a lot of different strategies that we can look at, but there's two on here specifically I wanted to look at, and both of them had an increase in terms of their interest post the crisis. One is managed volatility, equity strategies, and the other one is risk budgeting. This gets into a little bit more. It just gives you percentages of where people thought was the most effective hedge, and then also, interestingly, where they thought the best value was. And again, the only thing I draw out here is hedge funds, which have traditionally been accepted as being the mainstay of mitigating downside risk, absolute return type strategies. Those aren't faring too well either on an effectiveness scale or also on a value scale. Sorry, one more slide on the survey, which I think is important. It's an interesting reflection and one we've certainly seen, and I'm sure in this room everybody appreciates, but the number one hurdle in terms of allocating towards asset classes that help you diversify and help you mitigate downside risk was liquidity, and also regulatory issues with the investments that you're going into. So a couple of the strategies I want to talk about today address those two things from a regulatory standpoint and from a liquidity standpoint. They're not the only assets you could invest into, but they're two that I'd like to highlight today for the very reasons that reflected this survey. So let's talk a little bit about tail risk and what does it really mean. For a lot of people it has different meanings, but effectively when you look at, this goes back to the 1920s, and I apologize, it is U.S. from a historical standpoint, but it does demonstrate, you have periods of substantial drawdowns, and as I mentioned earlier, in the last decade, you've had two 50% drawdowns in the U.S. market and then pretty much mirrored in the global markets. And the question we ask and the question clients ask us, especially pensions, is what can we do to try to mitigate those downsides? How do we avoid that degree of downside when it does come? And of course, you can't predict. I go back to that slide. I don't think anybody could predict, even if they knew the outcome of one of those events, what the market will actually do to respond to that. And that's, again, a very important observation in terms of the way that we look at how you should position your portfolio for these types of events. So I want to step back, and I apologize for putting a statistics curve up here. Unfortunately, I'm not a professor, and I won't be able to get into much detail here, but I thought it was just worth stepping back to just set the perspective of what a fat tail is and what we're calling black swans. But the green chart is a normal distribution. That's what theory would tell you is how returns over time should be distributed in the marketplace. And the observation, however, is much different. The observation is the blue line, which skews to the right, so you generally have more positive returns. But you also have what we call a fat tail. Apologize for the semantics, but a fat tail where it's way above. If you look at the space between the blue line and the green line, there's a lot more space there, which means you're going to have a lot more in actual reality. You're going to have a lot more large drawdown periods and unexplained tail events that would normally not play out theoretically. So what are the general goals in tail risk management? One is trying to avoid that left tail, that fat tail. You want to provide some downside protection, but we also recognize that if you hedge everything perfectly, then you have no upside protection, and that's clearly not the right approach either. So we want to be able to participate and offer strategies that help you participate on the upside as well. So as I mentioned earlier, I'd like to talk about two strategies, managed vol. I'll start off with managed volatility. And again, slipping back a little bit into academia and some of the research that we've done internally at State Street, generally, and I put this slide up in a lot of presentations, and my colleagues do as well, and there's a general view that it just can't be right, because we all believe that you take more risk, you get more return. This slide argues the opposite, that taking more risk, going into higher beta investments actually over time has resulted in a lower annualized return relative to low beta stocks. We're not the first ones to do it. This research has been out for years, but we were given the crisis, we went back and looked at some of our factor tilts, some of the reasons for what was happening in the market, and we renewed this research that we were doing internally. And we've been talking about it for 3 or 4 years, and like I said, in the last 18 months or so, clients are starting to really become interested in this from an observation standpoint, and invest in strategies like managed volatility. So how do you manage a strategy? Well, effectively, we have filters. We do run quantitative strategies, even if they're active, and we look for low beta stocks with other features, and we do maintain diversification by country, by asset, and by industry. So based on that, fundamental challenge to the old view that greater risk equals greater return, managed volatility has actually proven to be quite popular strategies and quite effective in managing tail risk. A lot of blue on this screen. It happens to be our corporate color, so again. But the dark blue is the managed volatility strategy on its own, as you see on the top chart there, and the MSCI World Index. And as you can see, the drawdowns are much less in the managed volatility. Still 100% allocated to equities, just a different filter mechanism for avoiding high beta exposures and effectively managing your volatility at a disciplined level. So you've had substantial drawdowns. If you look at those two numbers on the right, managed volatility 35%, MSCI 54%. They are a significant difference, but I think the most important thing to think about is to get back to par. If you go back to that drawdown chart, to get back from where you are at the bottom back up to just breaking even, the fundamental difference in those two numbers is quite significant. Got to get my direction right here. Because in the managed vol strategy, you need about a 50% improvement in the market to get back to even. In the MSCI world, you need 116% return to get back to even. So it's no magic there, but managing that drawdown has significant impact on pensions in terms of getting back to where they want to be in terms of growth. And of course, from a volatility standpoint, you have a much better Sharpe ratio over time in a managed volatility strategy, which is important to our investors as well. A lot of data on this screen, but we have the advantage of not showing you theoretical, but showing you actual performance. This is a live strategy that we launched in 2008 for our global managed volatility strategy. And you can see that where this strategy will not necessarily work is when you do have strong upward moving markets. This strategy will definitely lag, and there's no free lunch. I think Milton Friedman said that. There is no free lunch. If you're going to have downside protection, there will be some cost to it. Our goal for you is to try to minimize that cost, and we believe this is a very cost-efficient way of attracting downside protection. But you see, when the market performs quite well, this is quarterly, but when the market has strong momentum as it did back in 2009 after the lows, this strategy would have lagged the MSCI world. So you don't want to be 100% in this strategy. We would recommend a certain percentage goes into it from an allocation standpoint. But over time, you can see over the last 3 years, it's outperformed by about 344 basis points, and since inception, about 226. 1 year number has been quite exceptional, almost 1,000 basis points outperformance. So I'm going to shift to the other strategy, which is a cash plus strategy, which is really a risk budgeting strategy. So we have an asset allocation group that manages about $200 billion internal at State Street. We've been doing it for some years. This is something we've been working on, again, throughout the crisis. We've always had it in-house, but we really started to refine it during the crisis, trying to see how it was reacting to the macro environment that we see out there. And the way that the group uses this, they use this to tailor their risk appetite within an asset allocation strategy. So if a client hires us, they'll come into what we have on the next slide I'll show is a cash plus strategy. So cash plus 2, cash plus 3%. But it's really tactical asset allocation. And the team uses this not in a quantitative format. They use it as a guide to tell them when they should be putting risk on and taking risk off. It's a little bit different in the sense that when it becomes on the left-hand side, you see our comments on what type of environment you're in. And if you're in a crisis mode, you have high risk aversion, which we're all quite used to these days. But when that starts to reverse, we start putting risk on quite quickly, as you would expect. You're trying to capture when everybody's running. You want to actually start investing. But we use this as a gauge of when it's safe to start going back into the water. So when our MRI starts to come back down, that's when our group starts to allocate towards riskier assets. And indeed, when you hit euphoria, there will be, as that moves off of euphoria, you want to be involved in the market. This is the whole thing about tail risk protection. You want to be involved in the market when it's going up. We use this indicator, which is a composite of a bunch of risk measurements for the market, implied risk measurements. When this starts to rise, we start to come out of risk assets and start to get more defensive. And you see our risk budget, which is reflected on the right-hand side there in terms of the way the group operates from an asset allocation standpoint. And again, apologize for the colors, looks like an upside-down volcano, but this does also demonstrate the blue is the cash plus 2.5 strategy that we at SSgA manage internally, and the red is a 75-25 equity bond split. So you can see here that this is over a short period over the last 2 years, but you can see where you had 10, 12, 13% drawdowns in a 75-25 mix. Our cash plus 2.5 asset allocation using that MRI as a risk judger has actually reduced that drawdown quite significantly to maximum drawdowns of around 4 to 5%. And then finally, I'll just wrap up. I don't have a summary slide, so I'm going to wrap up on this slide. But I think one of the things our investors are looking for too. We're talking to a lot of investors about how do I protect myself on the downside? How do I reduce my volatility? Now this is the cash plus 2.5 strategy on the blue line, and you can see this is compared now to 100% equity index, the FTSE World Index. And we're only showing this for the purposes of showing you that this type of strategy, asset allocation with a risk budgeting methodology, produces a much smoother outcome. Over time, you're clearly going to make, in an up market, you're going to make more money being wholly exposed to the equity market. But the proof of here is that lower volatility, and over time we think quite competitive returns relative to an equity or an equity bond exposure. With that, I'll leave it at that. Those were the two strategies I wanted to highlight. So thank you very much.